Hello, this is Steve Lentz with Discover Options. Welcome to this edition of the Market Reports. Today, we will have the S&P 500 Condor Butterfly Timing Report from Friday, August 12th, getting ready for the open on Monday, August 15th, and also the S&P 500 Directional Likelihood Report. Presented material is for educational purposes only and should not be construed as personalized financial advice. Folks, we'd love for you to subscribe and get notice when we produce another market report. Just click on the button below and subscribe to our channel. That'd be awesome. And the other thing is that if you click on the link above, we can get you this ebook. It's a free ebook, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. On to the reports. We have two of these for you. First, the S&P 500 Condor and Butterfly Timing Report there. This is for traders doing range trading using these options strategies, condors and butterflies. These are pretty sophisticated signals and statistics we're going to show you, so bear with us here. We're going to show you the methodology behind this as well as the likelihood report as well. We're going to go over the why of this report, the methodology, and then we're going to get into the current condition of the market and then the edge level that you have for trading condors and butters. Why would you look at this report? Well, if you were to go back to December 31st, this is just a cherry-picked example, but here you could see the market was beginning to trade in a range. Yet if you look at the report that we generated at the time, there would have been a minus 4.2% edge to doing condors and butterflies at that moment on December 31st. What that means is at the time there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. And then indeed, look what happened. In this case, the market went quite volatile on the downside. So there was a little bit of foreshadowing going on with the report. And so let's get into how we do this. Here's the current market condition. All right, and we divide this into three parts. The price action, in this case, Thursday was an upswing day, followed by Friday being an inside day. The trend, we're above the 50-day simple moving average, and then the overbought oversold level, the stochastic 15.3 is between 65 and 99 and barely above the the 3-day simple moving average. So we're in an overbought condition on the stochastic. We're in an uptrend, and we had an upswing followed by an inside day. That market condition has existed about 80 times between now going back to about January of 2000. All right, that's how many times it's occurred. Now, when you look at those 80 times in the past that it's occurred, we can look at those and answer the question, is this condition a good one for selling option premium through range trading, condors and butters? That's what we're going to get to here. So how do we do that? First, we observe how much the market actually moves from a given close, and we call that actual volatility. Then we observe what the market move was predicted at the time by the option prices. We then compare the two and then label each bar favorable or unfavorable for selling premium. So here's an example of the indicator on the bottom is the actual move. So if you have a close at 2076 and you move forward in time 21 days and look at the farthest distance that it moved, the market moved down 50 points at one point. So that's a move right around 2.4%. which is what we then label in that indicator that measures this kind of thing. Now, here's the question. At the time, all right, back at the time when we're looking at that, April 28th or so, what was the market move being implied at the time by the option prices? And when you take the VIX, all right, and take a look at and you use an algorithm to come up with the implied move. The implied move from the VIX, 30 calendar day, 21 bars, it was at 4.4% at the time. So the options were implying a move of 4.4%. The actual move that occurred was at 2.4%. So on April 28th, that bar turned out to be a favorable bar for selling option premium. The market didn't move near as much as what was being implied. So we would then paint that bar blue, and we paint all the bars blue where that's the case, where the implied is above the actual move, the implied move being above the actual move. Now, we don't really know most recently, like for instance, here Friday's bar, we don't know if that's going to be favorable or unfavorable. We have to wait 21 days. All right, but you can kind of see here where we go through, and whenever the implied move is above the actual move, we paint the bars blue. We paint them red when they are unfavorable, where the actual move is higher than what was being implied. See that? So here's what we do. Historically, we look at what percentage of the bars are favorable. So we go back in time, and we go back to January of 2000, and we look at the percentage of the bars that were favorable. Then we look at the bars that match our current market condition. And as I told you, there were about 80 or so. What percentage of those 80 were historically favorable for selling premium? All right, if 100% of them were favorable for selling premium, okay, well now we're talking there's a big edge then. So let's go take a look at what the difference is between the two. 64.6% of all the bars going back, about almost 4,200 or so, are favorable. So, just barely something short of 2/3 of the bars are favorable for selling premium. A little bit less than 1/3, a little bit more than 1/3 of all the bars turned out to be unfavorable for selling premium, meaning that if you had done condors and butters, you would have been in for a bit of a wild ride, okay, where the market was going to move more than what the options were implying. All right, so that's roughly at 2/3, 1/3, give or take. Now then, let's go and look, and here we can see over the last several months, there's only been 2 bars that meet the current market condition we're sitting at here on Friday. Oh, let me just run that back here. Send it back. There we go. All right. There's only 2 on the screen here, but what we're going to do is look at all of those going back, and we ask ourselves what percentage of those were historically favorable. And as it turns out, of those 80, 77.5% turned out to have been favorable for selling premium. That is quite a bit higher than that 64.6. So there's a 12.9% edge right now. That means that there is a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. Okay, so it's better than a coin toss, is what this is saying. If you go back and look at the current market condition each of those 80 times, only 22.5% turned out to have been unfavorable bars. So pretty good for the Condor premium collection strategies. Okay, so that's it for the timing report for the Condors and Butters. Hope you found that helpful. Let's go on and take a look at the market likelihood report. Before we do, I want to make sure you know at Discover Options, we offer a full array of mentoring opportunities for you to get up to an advanced level of options trading. We offer futures trading, we offer equities and index trading, we deal with earnings, announcements. You can take a class in that. But if you want to get to the place where you are a sophisticated trader trading condors and butters with adjustments and understanding what market conditions are good for doing those, this is the place you want to go. We have professional options traders that will mentor you and take you from the beginning, wherever you're at, beginning, intermediate, all the way up to the most advanced levels. Even money managers have come to us to get better at managing money, trading options for their clients. So go to the website. You can give us a call. We'll go over all the curriculum with you and piece together a curriculum that really makes sense for wherever you're at. Okay. Let's look at the market likelihood report. This is a interesting methodology we use here. Basically, we look at the current market condition and we ask ourselves this question. Since January of 2000, how often has this same condition occurred? And I told you 80. What happened at each of those 80? Did the market go up, down, or stay, kind of neutral and didn't go anywhere? So instead of talking about the specific Condor butterfly strategies, we just want to simply get a feel for what the market is likely to do in terms of going up, going down, or wobbling around, not doing much. So what direction did the market go on each of those 80? We want to get a feel for the likelihood of a directional move. So here's how we do this. We first have to understand the historical distribution of price to get a baseline. Then we look at our 80 times when our market condition occurred, and we want to understand the price distribution from each of those 80 times that it happened. If there's a difference between the baseline and then those 80 occurrences that match our current condition, well, then we might discern that there's a tradable edge. So how do we approach the distribution of price? Here we go. We measure the distribution by observing how often price touches the 1 standard deviation volatility bands that are placed from each bar's closing price. I use 5, 10, and 15-day bands. These are measured 1 standard deviation from the close. I use 20-day historical volatility, and these are log normally distributed. Here's just a quick example, real quick. You take a close, you measure standard deviation up, standard deviation down, and the question is, over the next 10 days, did price go up and hit the high band, go down and hit the lower band, or wobble in the middle over the next 10 days? And in this case, the market clearly went up and hit the upper band. So for that particular close, we record that it hit the upper band. Okay, now let's look at the close right up here. We have a band up here. We look at there for the next 10 days. This one for the next 10 days. And did it go up and hit the upper, the lower, or wobble in the middle? Let's take a look. And if you look real carefully, you'll see that it actually hit neither of the bands. It came close, but didn't hit that band over there, and it clearly didn't go up and hit the upper. So this one, for this particular close, it hit neither band, and that's what we record in the database for our statistical understanding of the distribution. Now, look at what we do here. From every close, we record how often price struck the upper, the lower 5, 10, and 15-day bands. Okay, now watch this. If we have a real good indication going on here that price is going to go up, don't you think then that over the next 10 days that price should hit this upper band more often than the standard distribution? Okay, or if you feel that there's a real good signal there that generates a good solid bearish signal, you would expect that the lower 5, 10, and 15-day bands would get struck more often than the baseline. And that's where we're going with this, all right? That's where we're going. So here's what we have. All right, over 4,172 closes, price struck the upper 5-day band 29.44% of the time, the upper 10-day band 23% of the time, the upper 15-day band almost 23%. It struck the lower 5-day band about 30%, lower 10 about 30%, and the lower 15 32.4% of the time. So that is the baseline distribution. Now if you have a great bullish indicator, and when it goes off, you would hope that it is striking the upper bands more often, and hence hitting the lower bands less often. That's where we're going with this. Okay, we want to understand the baseline distribution and then we're going to see what the distribution is after our particular market condition we have right now. And by the way, I've done a lot of work looking at specific market setups, moving average crossovers, stochastic setups. I have a huge library full where I know which ones are going to generate instances where the upper bands get hit quite a bit more often, and there's an edge. Likewise, there's some great bearish indicators where the lower bands get struck a lot more often than the historical distribution. So that's part of the Discover Options archived presentations that I've done over the last 2 years of studying this. And you may want to consider that when you look at enrolling in any of the courses we have. We can arrange for you to have access to those archives. Okay, now, here's what we do. We look at the distribution after our condition develops. So here we have our market condition. And we're going to look at the distribution in terms of the 5, 10, and 15-day bands. We're going to look at the distribution as of the close on Friday, for example, or in each of those 80 going back. We're going to look at the distribution that occurs if price goes above Friday's high. What if price goes below Friday's low? What's the distribution there? That'll help get you prepared for Monday's open and for the Monday trading day. All right, so let's take a look. At the close, we had 80 occurrences, and of those 80, just a second here. One moment. Let me grab this and pull this down. I'm sorry. There we go. All right. There we go. So in this case, the market, of those 80 occurrences, the market struck the upper band only 11.3% of the time. That's quite a bit lower than the baseline distribution of 29.4. So after our current market condition, as of the close, it strikes the upper 5-day band way less often than normal. It strikes the upper 10-day band far less often than normal, as well as the upper 15-day band. It strikes the lower 5-day band a little bit less often. It strikes the lower 10-day band about the same, and it strikes the lower 15-day band far less often than normal. So what we're seeing here is a picture of a likelihood that the market will encounter lower levels of volatility. It's typically striking all 6 of the bands less often than normal, and that makes for a favorable circumstance for doing strategies like condors and butterflies, where we are typically going to encounter then lower levels of market volatility. That's what this is saying. Now, what if price goes above the high? Because this is the report as of Friday. If Monday price goes above the high on Friday, we have a similar situation. Of those 48 occurrences, okay, the price struck the upper bands way less often than normal, as well as the lower bands less often than normal. And if price goes below the low on Friday, look at this, it still is striking all 6 of the bands less often. Very interesting. I mean, it's not unusual, but I think that's kind of what we're seeing here, is we're not seeing very much of a bullish bias or a bearish bias. We're seeing a bias towards lower volatility in general. Now, one thing I like to do is repaint those bands. I like to repaint those bands, redraw those bands. Instead of using a 20-day statistical volatility number, I use a SKEW adjusted VIX number. So watch this. The VIX is typically higher than a 20-day statistical volatility. The VIX is typically higher than the historical vol that you can calculate from the last 20 days. All right. Now, because the VIX is higher, when we use the VIX to draw the bands are going to be wider and farther apart from the close than the other bands. Hence, those wider bands are going to get struck less often. Instead of being at 23 to 30%, Here you see them getting struck roughly 15 to 20% of the time. Now watch this. I use a skew adjusted VIX to account for the fact that in the options world, the out-of-the-money calls have a much lower implied volatility than the out-of-the-money puts. So what I do is for the lower bands, I use a higher volatility number than I use for the upper bands. The upper bands use a skew adjusted upside volatility. The downside bands, we use a skew adjusted VIX that's a downside volatility. So the bands are kind of skewed that way. I wanted it to reflect more what the market is truly saying about where those bands should be. And even when we do this, we can see that all 6 of the bands are getting struck less often. Now, if price goes above the high on Friday, still all 6 are getting struck less often. And then, of course, if it goes below the low on Friday, they get struck less often then as well. So again, a definitive picture of lower volatility. The market is very likely to encounter lower levels of volatility than normal. Is that guaranteed? No. It's just simply saying here that if you look at history, if history has anything to say about it, yes, the market is more likely than not to be less volatile than normal. Here are the volatility numbers down here we use. The 20-day statistical volatility is at 7.4%. That's very low. The upside skew adjusted VIX is at 9.7. The downside VIX is at 13.4. Now, let's use that 13.4 number because we're going to go take a look at a market, just a trading idea, and I throw this out every week, a hedged bull put spread. Instead of using condors and butters, if you're generally bullish, we're above the 50-day moving average and everything like that, what we can do is use the downside skew adjusted VIX at 13. Here's the VIX at 11.6 right now. And if you run it through the just the algorithm from the SIBO published skew number, we get a downside VIX that's a bit higher and the upside VIX is a bit lower. Let's look at that 13.4 and use that in our option view software program. So we go to option view and we're going to devise a hedged bull put spread, and we plug in that 13.4 up here. That then in option view, here we have all the puts. What we're going to do is take the at the money put and note that the out of the money put that's a standard deviation away is right there. That 13.4% helps us paint these strikes mauve or blue. The first one out in the blue is the first strike outside the first standard deviation. So here's what we do. We do a credit spread here, a 5-lot 20-point spread in the SPX. One standard deviation away, it's at the 2090, and you buy the 2070s. We'll do that 5 times, and then we go to the at the money put, and we do a bear put spread, buying a long at the money put, selling the next strike out, and that is our hedge. If the market goes down, this spread is going to make money, and it's going to help mitigate losses from the credit spread if the market keeps going down. We make sure, though, that this credit spread is bringing in far more money than it requires to buy that hedge. And so we have a net positive here, a net credit coming in, so that when we analyze this picture in option view, we can see no matter how far the market goes up, we're getting 5% on our money. And then if it does go down, then that hedge kicks in, and we can make upwards of 17% at expiration, unless, of course, it hits the strike right there. If it hits that strike, well, then we're going to lose money at expiration. So this is a hedged bull put spread. It gives us, a little bit of a reward. If the market goes down and gives us a headache, we're at least going to get rewarded for it while we navigate the waters of this down here. Otherwise, if the market keeps chugging up, well, then we make money as well. 5% in a month isn't too bad. You could probably pull it off for 4% if it does go up, pull it off for a 4% yield in fairly short order. When you look at the price chart picture with the profit graph, that's awesome. You have the green area that's very, very wide. the market would have to go down at a very quick rate. And if it shops around at all, at least we're going to be in the money there. So that's it for this week. I'm so glad you joined us. We'll see you next week. Same bad time, same bad channel. Check us out at discoveroptions.com. We'd love to hear from you. Take care. Have a great week. Bye-bye.